Okay, champs, welcome back to Libertas Trading and welcome to the event preview for UK CPI at 7 a.m. on Wednesday, the 19th of November 2025. So, in the last few previews for the UK, for example, the labour print, the GDP, we've spoken at quite detail about the UK economy. So, I won't go into too much detail, but basically, we've got the upcoming budget on the 26th, which is expected to be pound bearish. We've got sticky inflation, which we'll talk about in a second. We've got a weak labour market. We've got weak growth. We've got wages that have been really sticky, although it's looking a bit more promising now for the Bank of England. So yeah, real tough situation for the Bank of England at the moment. They're sort of in a place in between a rock and a hard place where, they want to cut rates to stimulate growth, to stimulate the labour market, but they can't cut rates because inflation's too high. So yeah, we've basically got 58 basis points of cuts priced in for the December meeting and the remainder of next year. We've got about 20 basis points of cuts priced in for the December meeting, which is an 80% chance of a cut. So it's looking like they will cut in December, and I think a low print on inflation will solidify that. Just looking at rate pricing, you could say that, all right, if we get a really hot print, maybe that December rate cut goes to a 50-50, but we'll talk about why buying the pound tomorrow might not be the best shout in the trade scenario sheet. So we'll quickly head to that now. So just looking at the trade scenario sheet, firstly, just to note, due to past reactions, I'll only be looking at downside in the pound. The last three beats we've had in August 2025, July 2025 and May 2025 have traded very poorly, probably and most certainly due to stagflationary concerns. So until I see a decent reaction out of UK data on a massive beat, I'll only be trading misses. Wouldn't blame anyone for trading a beat tomorrow. We may see some good moves out of a beat, but just based on past reactions, I'm only going to be trading a miss tomorrow. So let's have a look at August and July. I won't waste too much time. So this was pound dollar on the 1 minute chart for the August print, and you can see here, it wasn't amazing print by any stretch of the imagination, but fairly decent print. And this massive spike low would have got a lot of people in trouble if they entered straight after the data. And then just really dreadful moves here. Just going down to the 5-second chart quickly. So this is cable again on the 5-second chart, and you can just see here how bad price action was. If you think you're probably getting filled at like 134.99 or something up here, and price just traded sideways, or you'd have lost money on this one. So price basically came back down to pre-event levels within about 9 minutes. So again, this wasn't the best beat, but you could also argue that the bigger the beat, the bigger the stagflationary concerns. So maybe in this circumstance, a smaller beat is the best way to go for a trade. I would probably rather trade a huge beat, but again, that does increase stagflationary concerns. So, not ideal in the slightest. Now just head into that July print I spoke about. This was a much bigger beat. So we had both the cores printing above the high and 0.2 above the forecast. We had the headline CPI print above the high and about 0.2% above the forecast. The services printed pretty high as well. So, at 4.7 in line with the prior. So again, not like the best print of all time, but just look at the reaction. So very disappointing here. Within within an hour and a half, you're back at pre-event levels. Again, if we're getting filled up here somewhere, for the first half an hour of the trade, you're underwater, you're probably getting out, which you'd be right to, and you're going to lose money on this one. So yeah, this was a really bad print as well. So yeah, just considering the last sort of 3 tradable prints we've had that have been beats have all reacted horrendously, I'm not risking my money on that. So I'll be staying out of this one on a beat. I'll still do the forecasts and stuff and reactions for a beat, but I won't be trading it personally. If we just have a look at last month's print as well, that might give us a bit of insight into what we can expect from tomorrow and why we're expecting a move on a dovish reaction. So last month's print wasn't the greatest again by any stretch of the imagination, but we did print minus 0.2, or we did print 0.2, sorry, below the consensus on the headline, the cores and the services year on year. So, these are the numbers I'll be looking for today. Or tomorrow for a trade. So, this one moved quite nicely on a miss. If we go down to the 5-second chart, we can see how nice it would have been if you entered within that first 5 seconds. You're getting a really nice fill, and you could have either taken profit down here, or you could have held the trade for a longer amount of time, which would have been really nice. And then really to find the miss before last month, you've got to go back to the year prior, which was October of 2024, where again, we saw some pretty weak numbers here, and we saw a really nice reaction in the pound. So just going to the 5-second chart to give you some added context. You can see just how nice that move was. Okay, we had a little pullback in the first sort of 90 seconds, but apart from that, you're in the money for the whole trade, which is very comforting when you're risking a lot. So going back to the trade scenario sheet, now we've seen some past reactions and just talking through the numbers I'll be looking for. So for a dovish reaction on the headline CPI, so basically for UK CPI, we're looking at these 6 prints. I'd probably say that the core and the services are the most important, but I sort of give all of these equal weighting. We've got a lot of information that comes out tomorrow, but I give that highest weighting to these 6. And we want to see on aggregate, most of these come with these numbers or most of these come with these numbers. If we get a mixture of red and green on the calendar, give it a swerve. We really want some good numbers on this one for a trade. So for the CPI month on month, the headline, I'll be looking for 0.2% or lower on a dovish reaction, which is lower than 23 out of 24 of the analyst forecasts. And then for a hawkish reaction, I'll be looking for 0.6 or higher, which is above the highest and also the highest since May, which would be a pretty dismal reading for the Bank of England. And then for headline CPI year on year, I'll be looking at 3.4% or lower, which is lower than 31 out of 34 of the analyst forecasts and also back to June levels, which would be quite nice. And then for a hawkish reaction, I'll be looking at 3.8% or higher, which would be higher than 32 out of 34 analyst forecasts and would show no progress on inflation for 4 months straight, which again would be a worrying sign for the Bank of England. Then on the core month on month for a dovish reaction, I'll be looking at 0.2% or lower, which is lower than 23 out of 24 analyst forecasts. And then on the hawkish reaction, 0.6% or higher, which would be above the max and also the highest print since May. For the core year on year, I'll be looking at 3.2% or lower, which is below 31 out of 32 analyst forecasts and back to January levels. And then for a hawkish reaction, I'll be looking at 3.6% or higher, which would be higher than 30 out of 31 analyst forecasts and also show no progress in 3 months straight. So for the services month on month, which is obviously the main part of the British economy, so which is why this print's important, I'll be looking for on a dovish reaction 0.2% or lower, which is below the minimum. And then for a hawkish reaction, I'd be looking at 0.6% or higher, which would be above the max. And then for the services year on year, I'll be looking at 4.4% or lower, which is lower than 19 out of 20 analyst forecasts and back at December levels. And then for the hawkish reaction, I'd be looking at 4.8% or higher, which is higher than 18 out of 20 economist forecasts. So I don't know if any of you noticed, but I'm basically looking for a 0.2% miss and then a 0.2% beat from consensus. This normally leads to a decent trade for UK CPI if all of them come in like that. So for the expected reaction, we can look for pound down and FTSE up for a dovish reaction. And then for a hawkish reaction, pound higher initially, but there's a large risk of a reversal due to stagflationary concerns, which we've spoken about, and we've looked at the past reactions for that. And then also you can look at some FTSE downside, but I personally will be sticking to the pound on this one. Also, I think we need to be careful of worse than expected entry levels after the huge move on the last Labour print. Always check your risk before pulling the trigger. So just really quickly looking at the 5-second chart for that Labour print we had. So here's the 5-second chart on the euro pound, and you can see here very dismal data, but that price move there, I think I got filled. I didn't trade the euro pound, but I got filled around up here somewhere. So you don't usually see moves like this from pound data. So just something to be mindful of tomorrow when you go to enter the trade, just quickly check what your risk parameters are and to make sure that you're not risking more than you expect. So, if you're expecting a 10 pip fill and you're getting a 20, you're essentially risking twice as much. So always worth checking, but especially for tomorrow, just based on that UK jobs print, the market is very sensitive to UK data at the moment. So just something to be mindful of. So for medium term plays, for a dovish reaction, you could look at some pound franc downside. If you fancy risk off to continue, the Swiss franc has been on a rampage and the pair's feeling it hard. With Switzerland having agreed 50% US tariffs, we could start to see Swiss exports pick up, and the franc is now looking an even better place to park your money. So euro franc and dollar franc finding strength today down at major support levels would worry me though. So we'll just quickly look at that. So here's the pound franc chart. I'm not really worried about the pound franc being down at these levels. What I'm really worried about is the major pairs with the franc, the most traded pairs with the franc, which is the dollar franc, which we've got down at major support here and multi-year lows. And then also the euro franc, where we've found support, from this sort of quadruple bottom, maybe quintuple bottom. When I look for support levels on more obscure pairs, I always look at the major levels. So for example, for pound Aussie, I'd rather look at Aussie dollar and pound dollar to see what levels they're at, as opposed to looking at the pound Aussie. So yeah, just the euro Swiss franc and the dollar franc worries me a little bit about the pound Swiss franc trade. You could also look at some pound Aussie downside, which I've been trying to short now for weeks. So at the time of writing, the Aussie is the strongest on the session. We had a slightly more hawkish RBA minutes last night, and the pairs at a beautiful level to short. So we'll quickly look at that chart. Here's the pound Aussie on the weekly chart. Let's go to the daily quickly. Sorry about this. So we're at this really nice level for the pound Aussie, which we've, broken through that resistance there. We've then tested a support. We've then came back down, broken through it, and then retested it twice. And we're moving lower from that level. So really nice level to short here for the pound Aussie. So that could be nice for some more downside, maybe targeting that psychological 2 level. And then maybe after that, you could be looking at sort of like 1.98 on this one. And also just looking at some euro pound upside. So, maybe the safest pair, as it's the purest rates play and nothing too much is happening with the euro at the moment. We just need to be careful of that 88.50 level where resistance goes back to 2020. So quickly looking at the euro pound chart. So here we've got that 88.50 level. And if we just go onto the weekly chart, we can see just how big it is. So there we go. It goes all the way back to these levels around in 2020. So, quite a big level there at 88.50 and something to be mindful of if you are long the pair. And then for a hawkish reaction, again, I'm not looking at trading the pound on a hawkish reaction just until we start to see some validations on trading the pound upwards on hot CPI. But I would look at some euro pound downside. Again, maybe the safest pairs, it's the purest rates play and nothing too much is happening with the euro at the moment. And then conversely, 88.50 is a great level to get short and the pair is looking quite stretched. So we just looked at that chart there. And then for short-term plays, it usually pays to get into trades out of UK CPI pretty sharpish as it did last month, but be mindful of spreads and take appropriate time to assess all the data properly. I'll be sticking to pound, dollar and euro pound and decide on the pair depending on how euro US dollar trades in the morning. So for euro pound, I'll be looking for a 9 pip target, and then for cable, I'll be looking for a 17 pip target. So good luck, guys. Any questions, give me a shout.